Better if I turn off mute. Good afternoon, YouTube. Thanks for joining us. It's not Jerry, I'm afraid. He's otherwise engaged. Excuse me at the moment. So I'm stepping in for him today. So apologies for the less lovely tones. Markets have had, obviously, we talked about it this morning, lots and lots of news out this morning in terms of PMIs in Europe, albeit a lot of them final PMIs. Inflation was a little bit softer again in Europe, or at least the headline. Core was off, and they are a bit worried about core, which we'll talk about again in a minute or two. We had the guard on the wires, moving markets, and then later on the ECB monetary policy account. So quite a busy day for the euro and European bond markets this morning. If we take a quick look at the currency itself, I can bring my charts up. Helpful. We've seen some. Have a look at just the day's action. Had a pretty aggressive sell-off, interestingly, given the PMIs that came out from Spain at 8:15. They were slightly better than forecast, so it wouldn't have been the way that I would have traded it had I been trading this figure. But then we had a nice appreciation through the rest of the day. I think the ECB is seeing no clear evidence of inflation, which will come on of core inflation abating. So that's something that we'll have a look at and look more deeply into the comments from those policy meetings in a second. Furthermore, the inflation figures that came out at 10 o'clock, softer than expected. Again, you wouldn't expect this to be particularly strong for the euro at 10, but nevertheless, we saw the euro grinding. So maybe more of a dollar story. I mean, I know the dollar's been very headline driven of late. We've seen lots of news, obviously, about this debt ceiling. It looks like it's going to get passed before the deadlines we were talking about on Monday, having got through the House yesterday, Senate to come. But we did see a nice rally in the euro. And then as we rolled into the monetary policy council, let's take a look at what this included, because this was quite some interesting takeaways from the minutes here. The more decisive action was warranted to move rates into the restricted territory to ensure a timely return to inflation target. They said a number of members initially expressed a preference for increasing the key ECB interest rates by 50 basis points. That, I would say, is obviously a little bit more hawkish because we only got the 25 basis point hike that the market had by then had been anticipating, but there were still a number of, so not just the odd one, quite a few participants and voting members who felt that we might wanted more. They were negotiated down. As you see here, almost all members supported the 25 basis point rate hike. There was strong preference against returning to outright forward guidance. For those of you who are new, forward guidance is something that central bankers do to try and keep the market's well educated about what direction they're likely and what new paths they're likely to take. So they tend to, or they used to talk until this inflation spike about when giving you a time horizon on when they're more likely to raise rates or to quantitative easing, when they're likely to kind of make these adjustments with a decent time lag. That way, there's going to reduce volatility in markets, and that's the aim. It's not the mandated aim of a lot of these central banks, right? It's kind of job creation and inflation are the main mandates, but one of them, kind of secondary mandate, is to kind of keep volatility low in their jurisdiction, and by having forward guidance, by telling market participants what's likely to happen going forward, that can reduce volatility, make less snappy moves based on decisions that are made by central bankers without the broader market having any clue that that's what they were about to do. But these comments here, there was a strong preference against returning to forward guidance. But since this has obviously moved away from forward guidance since the inflation figures started coming through, and we've for a while, over a year now, that the markets, the central bankers are dependent on data. So if inflation is stronger, that's going to mean they're going to hike rates slightly more. If the inflation is weakening, then perhaps they don't need to worry about that so much. And that's interesting because we obviously have seen slightly weaker core inflation today, but this data wasn't available to the ECB when this meeting happened a few weeks ago. So this is kind of backward looking slightly. The fact that we are now seeing the core CPI in Europe ease a little bit. Obviously, we're not down to that 2% target, but slightly abating in Europe, which if we look further along in here, the core inflation trend is broadly seen as worrisome. They were actually still quite concerned about the core inflation thing. I know Bank of England are the same. They're not really seeing any credible and sustained moves lower in core inflation yet. But yeah, we are where we are with this. It looks like we are starting to see them easing off. We were just talking today in the office actually about how CPI used to be the figure of the month. So last year there was an absolute banging days on CPI figures, but the jobs data seems to be doing that this year a little bit more. So hopefully Friday gives us that with non-farm payrolls coming up at 1:30 tomorrow. Interestingly, since this ECB accounts, we've also had Villeroy on the wires, someone who does like to keep talking. On the way to beating inflation, will bring inflation back 2% to the target by 2025. So it's a little way away from now, 18 months from now. So yeah, very interesting. And this is all this Euro talk is all on the 25th anniversary of the Euro being founded. So yeah, quite a topical day for Euro in many senses. So I hope we're all out celebrating their 25th this evening. The sun seems to have just about come out for it. Data though this afternoon moves and has already to some degree moved a little bit more into the US. So had the ADP non-farm employment changes. This was up markedly from expectations to 7.8, so another pretty monstrous figure. Those of you who've been following the jobs data, I mean the ADP less so, but if you have a look down to the non-farm payrolls, we've had a lot of beats until recently on this. Here we go. So look at all that since February 2022. We've only had one miss on expectations since May last year. So over a year, we haven't seen a single miss on expectations on non-farm figure. So yeah, seeing more strength in the job market. I mean, the numbers are coming off, but these ADP figures were broadly a lot larger than the market was expecting. Echoed to a smaller degree by these unemployment claims. So this is obviously an unemployment figure rather than an employment one. So a lower number here equates to a higher number of jobs created versus a lower number of jobs lost net. But it was off only marginally versus the 236, up a smidge from last week. But really all eyes are on the manufacturing PMIs. This is probably the biggest piece of data out of the manufacturing, at least, that we get. It's the third largest in terms of long volatility that we've seen over the past few years. This is the one that or the ISMs, probably more services, I would say, which is out on Monday, but these move the markets as much as anything. It's only the non-farm payrolls and the Fed press conference that move the markets more than these figures do. So do pay attention to these. It's not just another one of these figures like the consumer confidence or whatever that doesn't tend to move the market quite so much. These ISMs can, albeit, as I say, the ISM manufacturing isn't quite as important as the non-manufacturing or the services that comes out on Monday. Quite like it being out on Monday. As I was saying this morning, sometimes we see them out the same day as the non-farm payrolls. We've seen that a few times this year. And trading big data at 3 o'clock on a Friday really isn't for people in Europe, I don't think. You don't want to be putting big positions on too much at that time. And yeah, to have two pieces of huge data in one day seems like a bit of a waste. So it's nice they've made it this Monday coming up instead. But yeah, the average beat and miss on this. So you can see here the forecast is 47. We've only seen about a 0.5 beat and miss on average of this over the past 6 months. So it doesn't tend to beat or miss by too much. It tends to be quite an accurate figure. But I'd also pay attention to the ISM manufacturing prices. This is a kind of inflation component, right? This looks more at the prices paid effectively for manufacturers, and this is something that wasn't really on my radar until inflation started ticking up a year or so ago. But this has been more effective in markets than previously, so perhaps pay attention to that one as well. See where we go from there. We are very close to the open. I'll bring you where we are with the gammas in a second. Let's take a look at the context for the US market. Let's have a look at the futures here. Seeing some pretty unchanged on the FTSE after what was a pretty nice start on the month beginning. We might see that initial buying around the opens on the US indices as well. We talk about the month beginning trades that we do here. Had a nice rally up on that FTSE. If I show you from 8 o'clock, we caught that pretty much out the gate, and yeah, nice little rally, 40 ticks. It was about 100 ticks higher on the DAX. So yeah, nice moves in Europe. Let's see if they're echoed into the US today. I've got my eye on a price a little bit lower than here. Just seeing the weekly value area low at around 32,800 on the Dow. So I'd be curious to see if we can get there. That would give me a target a lot higher. Yeah, about 270 odd ticks higher if it does manage to find some support there, and seeing upward strength on a first day of the month is not uncommon historically. Yeah, this goes way back to, I mean, probably before pension times. You see people get paid, right? So when people have been paid, they have money to invest, and when they invest more money than normal, that tends to put a long bias into a market. So you often see this statistically around the end of a month, around the start of a month, that there is that statistical bias that 3 or 4 days before the end of the month, 3 or 4 days after the end of the month. That tends to be when markets most consistently perform. Dow's already gone down and tagged that level, so I might have to go and have a look at some close action today. Let me bring up the let's have a little look at the gamma before I do. Where are we? Take a look at where we sit with the gammas at the minute. We're seeing, where are we? S&P 4200 looks like large gamma to me at the minute. And look where we are trading at the moment, a little bit below there. We are probably seeing, there was quite a lot of puts in there below. What's the net gamma is negative at the moment, so there are more puts than it is in the very early part of the session, getting a little bit weaker. But yeah, let's see. So it's currently holding on that level at 32,800. So let's see. And we do have the data out at 3. So is this really the time to be slamming into positions when you might have to get out of them within 30 minutes? Probably not. So I'll probably remain patient and wait for a clearer figure. Clearer moves at least after 3 o'clock. So yeah, let me leave it with you. I'm sure Jerry will be back with you by next Thursday, or we might even jump into me on Tuesday. Say hi. But yeah, thanks for joining us. If you do want to sign up for these videos, we do them every day, 10 to 8 in the morning for the European Opens, and every day on our YouTube, our Zoom channel. Sorry, only a couple of these out a week on YouTube. So if you want them, a little bit more of them, sign up through the details below the video. Thanks for joining us always.